Hello, and welcome to another interactive session on our live webinar series, Moneyfy Mantra, where we speak with industry experts on various personal finance topics to help educate our viewers on empowering them to manage their personal finance more efficient. Every Indian has an aspiration to reside in their own house, while some people would, also stay, say that, in metros they are more comfortable staying on rent. However, there is a mass demand of constructing houses in India. We also have government putting a lot of emphasis on ensuring every Indian stay in a well-constructed houses. So while in the process where every Indian has his own house, there is a large opportunity for the investors to capitalize on. So our discussion for today is on demystifying the housing sector in India, and to cover the topic, we have Ms. Shaily from Tata AMC. Shaily, welcome back to Moneyfy Mantra.
Hi, thank you, Harsh, and thanks everyone for being here, and a pleasure to be talking to you all.
Uh, yeah. So to give a brief introduction about Shaily, she has over 17 years of experience into financial services. She has been associated with Tata AMC since last 3 years and currently serving as head of products. While prior to joining Tata AMC, she has been with ICICI Bank, HDFC Bank, and Royal Bank of Scotland in various wealth management roles. Now, before we, straight jump, on our topic, let me give a brief introduction about, our Tata Capital Moneyfy app. It's a complete, it offers complete suite of investment products, 100% digitally. So one can start their investing journey in mutual funds through SIPs. One can also start investing into small cases, open their NPS account, which is largely for retirement, and also apply for loans and insurance products. So you can download Moneyfy app. There's a link given in the description below. So please do check out and download our app. I would also request everyone to follow, and subscribe, Tata Capital's YouTube channel to get the latest update on various financial offerings. I would also request viewers to put in their comments if they have any questions on the chat window. We would be happy to take those questions towards the end of the session. So over to you, Shaily.
Thanks once again, Harsh. And we'll straight, I think, dive into our agenda for the NFO. If there are any other questions, we will take them up in the Q&A. So let me share my screen. I hope this is visible.
Yeah, Shaily.
Okay, great. So thanks everyone once again. Tata Housing Opportunities Fund. That is the topic for the evening. Now, one thing which I would like to mention at the start, right at the start, is housing opportunities. When I say, or when we say, it does not mean investing into physical real estate or real estate developers. That is what this fund is not about. What this fund is all about is what you can see in this, picture, the hero picture as we call it. So this fund would like to construct a portfolio of all those companies which go into making a home. Like when the walls are constructed, cement goes into it. So cement companies, walls are painted. So paint companies, before the painting is done, wall painting is done, you have your electrical fittings, cables, wires, switch gears getting, fitted into them. So it is about those companies bringing in those cables and switch gears and wire companies. Then you have tile companies, you have glassware and sanitary ware companies. Furniture is being put up in the house, so you have plywood companies and laminates, appliances, all those kinds of companies. So this is the building material portfolio largely, which we want to bring wide this fund. There would be some amount of NBFCs and banks also reflecting, and but largely this fund is not about investing into real estate developers or listed real estate developers. And as we go along, we'll talk more about why not that and why this section is what we've chosen. So as you see, the housing sector value chain, it's mapped very well to the house. I would again reiterate the cables and electricals, cement and cement product companies. You can see plywood boards and laminates, sanitary ware, air conditioners and other appliances, glass, paints, tile companies, engineering, design and construction companies, electric utilities, and of course some bit of housing finance companies as well. But underlying definitely remains housing sector. Now, before getting into why the housing sector now and how is it doing, just a little bit of differentiation between a real estate sector itself and these allied products which we spoke about, the tiles and paint and everything. Real estate sector is a cyclical sector. Investing into real estate, physical or the real estate developers. One, they are far and few which are listed. Two, they are very, the business is very capital intensive. And three, it is very cyclical. On the other hand, and of course, the business is capital intensive because you have a lot of capital requirement right at the start to buy the land parcel, to do the construction, and profitability is back-ended when you start selling the ready pieces. But till that time, you require a lot of capital. Whereas if you compare this to the business model, let's say of any allied product industry, a tile or a paint industry or any other industry which is manufacturing, let's say glassware or sanitary ware, they have more of working capital requirements. And even if the real estate cycle is going through some tough times, there is a replacement demand which is always there. These companies, all these allied product companies which service the real estate sector, are very capital light relatively. And as I said, all probably that they require is working capital, and the debt on their books is quite less as compared to real estate. And that is why even during tough times, because the debt is less, the leverage is low, they can ride through the tough times well. Whereas smaller developers or developers themselves go through tough times if the debt is because the debt is large and they have to go through rounds of equity raising and all those challenges are there. But having said that, that's the differentiation in the business model, and these two segments under the real estate segment itself, and the allied products which cater to real estate. That's the differentiation we just made. Having said that, the housing sector is already picked up in the last 1 or 2 years, and that's the household capex or the upcycle in the real estate is showing currently. There are reasons why. Of course, there has been a slight uptick in prices, home prices, and that is what has encouraged the fence sitters to buy the houses. And potential home buyers who are sitting on the fence are now looking at buying, and that's why the demand is getting created, because a slight uptick in prices is making them go and buy right now. It's creating an urgency in the expectation that prices would increase further. There is some amount of wealth effect which has been created over the last 2 years, especially because the stock market has done well. Of course, it's been very volatile, but it has done well and it has grown, and that wealth effect needs to somewhere get diversified also. So that is also another driver for why housing sector is doing well, is likely to do well. There is an income effect because there are a lot of employers in large metropolitan cities who have these employment hubs, and because of that, people are flocking to those hubs, and housing demand is getting created there. We know Bangalore, we know Pune. These are the employer hubs which drive the housing demand there. Higher rentals. So now rental expenditure has grown faster than housing prices. And then there, when a person makes a comparison, definitely the demand for housing prices goes higher, because a person probably would want to buy the house rather than spend more on the rentals. Mortgage rates are low. So yes, the interest rates have risen. But this rise in interest rates is actually a rationalization of the deep cut in interest rates which was made to safeguard the growth during COVID period. So if you compare the current interest rates to pre-COVID rates, just a few bips higher. So mortgage rates are currently lower. We can say that, and then investors are then encouraged to lock their buys or home buys at current lower rates. So lower mortgage rates are also helping. And developer confidence. On the supply side, a lot of consolidation has happened, and smaller developers have consolidated into larger developers. Inventory has gone low. There was good 35 months of inventory, which is now gone to 20 months. So the supply demand situation has kind of improved, and the developer consolidation has happened. The stronger developers have gotten stronger, and they are undertaking new projects now. Their confidence has increased. So all this is finally leading to a spike or an upcycle in the housing sector. Having said that, it remains the earlier differentiation which I made between the real estate investments in the real estate itself or the real estate developers were vis-a-vis the allied products remains. But finally, the underlying sector of these allied products, even if you're investing in allied product companies, the underlying sector remains housing. And that is why the first part of the presentation is to convey on what we think about the housing sector. And that's where we are right now. The second part of the presentation, we speak more about the allied industries and the fund, the portfolio itself. Coming back to the first part, discussing about the housing sector, last few years, of course, the sector has gone through a lot of lull. Lower prices had fallen, revenues were low. A lot of events happened, demonetization, regulatory changes, which is RERA. Not all developers could take the regulatory changes very well. GST, NBFC crisis in 2018, December 2017-18, when, the upcycle had just started, we thought. Then it was hit by the IL&FS and other and the liquidity crisis, the NBFC crisis, and again this period, this real estate was again hit. And now we see some green shoots, we see some recovery post COVID now in FY21. It is led by lower inventory and stronger pricing power by the developers, and inventory is low, which means 35 months of supply has now come to 20 months. And because the supply has reduced and the demand absorption or the absorption has increased, there is a good equilibrium between demand and supply, which is supporting pricing now. And supplier consolidation, as I mentioned earlier, and very importantly for buyers, the affordability has improved. There is a slide here which speaks about affordability, which means EMI as a percentage of the household income. If you see that index across cities as compared to 2010 and 2020, in 2021, the bar, if you see the light blue bar, is lower. And this index, lower the better, because which means that lower affordability index means EMI as a percentage of household income is a smaller share now, which is a good thing. Your affordability has increased. And then people can think of definitely buys. If the affordability has improved, it can think of more. So that supports the demand side very well. And with this support with this kind of support on the demand side, if you have muted price appreciation, bringing in that angle that prices would increase further, not very high interest rates, and income levels, and a lot of developers adjusting to the required unit size. Not that all the units, all the house units available are very large. You have all formats available, smaller unit sizes, and developers have adjusted to the unit size. All these things coming together, the real estate or the housing sector looks stronger. That's the point which is being made. Again, just a recap on housing demand drivers. Affordability we spoke about, that's the best in 2 decades. It's come down since 2010. We saw the data. The affordability index has come down, which means the affordability has improved. Urbanization. urbanization, if you see, I think we have a slide on that as well, because a larger population of India is now flocking to the urban areas. The share of urban population is now up as compared to, I think, 2010 again. And because suddenly a flock of population has happened there, the urban housing shortage has increased. So there is room for urban housing to come up. So that's on the macro side. On the micro, demand supply situation has become better because inventory has steadily declined and your consolidation in developers. And then government is also supporting externally by launching a lot of schemes, by supporting, giving liquidity support to NBFCs, by launching urban housing schemes. And, that is also lending another, help to the demand in the housing sector. This is the slide as I spoke to you about housing urbanization. If you see, 34% is in 2019 vis-a-vis 28% in 2001. Sorry, not 2010. 2001, it was urban population share in India was 28%. Now it has risen to 34%. So as the urban population has increased, of course, because of urbanization happening, the urban housing shortage has also increased. The number of units, short units were, let's say, 1.5 crore units in 2007. Now the short units is close to more than 2.5 crore units. So, definitely that creates a demand. This is just the data on how the consolidation has happened. You look at Chennai and look at Gurgaon. In Chennai, there were 259 developers in 2011. With consolidation in 2019, the total number of developers is just 70. And in Gurgaon, it was 58 in 2011, which has fallen to 16. In across cities, the developers have actually crunched because the smaller developers found it very, very difficult to, adapt to the changes in regulation, to changes in customer preferences. Suddenly the formats change, the unit sizes are changing, and the liquidity crunch, post 2017, what the industry faced, the liquidity crisis. So maybe their smaller developers asset liability was not, strong enough to go through all of that, and the larger developers could survive through that phase. Uh, Largely to say, this is just a slide to say that across parameters, across metrics, the larger players are better, looking much better right now as compared to smaller players across liquidity to debt ratio, across interest coverage ratio, which is how much of your earnings, how many times of the interest expense is your earnings before interest tax. So that's your interest coverage ratio. Gross debt to assets, it's much more than 60% for smaller players. It's 30 to 40% for larger players. So there has been a healthy improvement in top developers. Policy support, of course, we spoke of how government has launched certain schemes to support demand. Now, that was the discussion on the real estate part in the housing sector. We come to a discussion on the allied industries. So if you see growth of housing sector, yes, housing sector growth has been there. That's what we discussed. Then that would is expected to lead to demand for components which go into constructing a property, like your cement and other materials, other building materials. And then once your major framework is done, inside you also require the other allied products like your tiles, paints, glassware fittings, sanitary ware fittings, plywood, laminates, consumer durables, appliances, everything. How different products have behaved through real estate upcycles. If you see, if you pick up any of these allied products, yes, their growth has come off, but their growth has not come off, largely. They have quickly picked up also. They are very, very resilient. So on the when real estate cycle is going through an upside, they capture it very, very well. But on the downside, they are very resilient because they have less debt on their books. They have replacement demand still to support, and their cycles are not very, very long. They are not very, very cyclical. And their requirement is only working capital as compared to real estate companies which have higher debt. Their capital requirements are huge, and their cycles are much, much longer, and they definitely can stay in negative growth for a long period. Also, if you compare the quality of businesses, as a real estate developer, quality, balance sheet quality to this, You will find across, whether you talk about return on equity, you talk about debt to equity ratio, you talk about debt to EBITDA, which is your earnings before depreciation, before interest, tax, depreciation, and amortization. So debt as a percentage of that, or you speak about cash flows. Across parameters, you pick up a real estate company, a good, strong real estate company, or vis-a-vis you pick up any of these allied industry companies. You will find the quality of business across these parameters that I spelled out are much better. And that's very much visible in the blue bars versus the orange bar. Uh, debt to debt to equity ratio is much higher, let's say, for a real estate company, but much lower for your paints and pipes companies and your consumer durable companies. Debt to EBITDA is much lower for all your allied industries, but much higher for a real estate company. Whereas a return on equity is much lower for a real estate company. And look at the blue bars, the first chart, the blue bars across all the paints and the allied industry companies, much higher. So strength of the business is much higher. Again, if you see, these real estate players are also impacted by the dynamics of these individual micro markets. For example, if there is an IT boom, and Bangalore and Pune are IT hubs, so Bangalore especially, if there is a IT boom happening, you will have real estate players doing very well in Bangalore. For example, in Bangalore, if you see the south-based player 1 and 2, 75 to 80% of their business lies in Bangalore. So they are so much regional focused. And that is why, the regional dynamics impact them much more than the larger country dynamics. So micro markets are much dependent. Even Gurgaon, if you see NCR, a north-based player, 80% of, their 80% of their business is in NCR. The largest north-based player has 80% of the business in NCR. Yeah, cities like Pune, Mumbai are much more diversified, but Bangalore, NCR are very, very, impacted by the micro dynamics also. But at the other side, look at real estate allied products. Look, unorganized to organized, and this has got only stronger post-COVID. If you let's read this chart first from the total organized market percentage. I'm going from from right to left. Look at cables and wires. 70 to 75% of cables and wires is an organized market. It's a big one. 65% of paints is organized market out of the total market. 65% of plastic pipes is out of the total market is organized. 50% of tiles of the total tiles market is organized. It's a good number. And within that, only ply, of course, lies at 35%. Within the organized market, the share of top 3 and 5% is quite healthy. So it has a good diversification also. You have 45% share with 3 to 5%, and the rest is with the organized market. Paints 50%, but the rest 50% is with the organized market. Plastic pipes, a large organized market, and top 3 to 5. So it's not very, very skewed towards the larger players also. So it's a very healthy mix, of the allied products. We come to the Housing Opportunities Fund, but first would like to convey to you about the universe. Now, there is a Nifty Housing Index, which is there, but let me convey here right up front that we will be benchmarking ourselves to that index. There is an index in place, but we want to be true to the theme, not true to the benchmark. There is an index, but we don't want to be true to the benchmark and just replicate the benchmark or hug it very tightly. And we want to be benchmark agnostic because we want to be true to the theme. For example, the benchmark could have a higher portion on financial services and banks. 35-40% is there. No, 25% is financial services, but we would like to cap it at 10%. And within the 10% also, we would be more, in this fund, we would be, playing it more through NBFCs. On our other MF book, we are definitely much more on banks. On the other side, the benchmark is also investing into, or it is also has allocations towards power, towards metals, oil and gas. And we think that those industries which are not directly related to real estate, we don't want exposure. We want to build a portfolio which of companies which help in building a home, like the building materials set which we spoke about, and then appliances and cement, appliances, and some bit of NBFCs. Some bit of real estate developer, if we find very, very strong, we could take. But unlike the benchmark, which has, and we will come to the benchmark split as well, and some of our peer funds also, have that kind of, they are much more attached, or pegging the benchmark. We want to be benchmark agnostic, but this is the entire universe. This is not just benchmark, this is the entire universe. 307 stocks, and this is the split. You have large caps, mid caps, small caps. Number of stocks in small caps is 228. You have a decent spread in mid and small. And there are industries which are unique to small caps, which you'll only find in small caps, sanitary ware, glass consumers, plywood boards. You have some industries which are very strong, but they are in the mid cap. So our skew, a benchmark skew, could be more 75-80% towards large caps. We plan to have 50 to 60% in large caps, and the rest in mid and small cap. And we will take a call, but we are not, because the benchmark is 80% in large cap and we should be in large cap. That's not the case. Because the benchmark is allocated like this: 25% to financials, it also has 13% of power, it also has 10% to metals, 6-7% to oil and gas, 3-4% to reality, does not mean that we will be also allocating accordingly. We would be probably more towards construction materials, more towards cement. We will be more towards those building material things. So we will be not so much skewed towards the benchmark. We would have our own construct, a bottom-up construct of the portfolio. That is where our peers are. The peer set, if you see, probably could be more hugging the benchmark, and that is why having the allocations accordingly. This is our universe. We want to go and construct a portfolio, with paint companies, glass, electric utilities, cement, then your durables, housewares, switchgears, tiles, plywood boards, and some bit of banks and NBFCs as well. If we like a real estate company, yes, we could also go there, but some bit. That's how we would like to spread ourselves. Just to sum it up, we aim to offer from the upcycle of the real estate, which was already started, as we've seen, and it is expected to continue for the next few years. And we feel that it's a good way, the investing into or constructing an allied products portfolio which cater to real estate sector, housing sector, is a good way to play this cycle, rather than investing into real estate developers themselves, for all the reasons that I mentioned. And even if there was to be some bit of ups and downs in the real estate, these set of companies are very, very resilient. These set of companies are low on debt. These have very strong balance sheets. We saw all the vectors, and the quality of business is stronger. Their revenues might come off from 25 to 15, 18, but it's not that they come off. And now for FY23, the expectation of earnings from these set of companies is about 18 to 23%. For all these subset which I just mentioned. And some market correction we've already seen, so that's a good entry point for many of these businesses. Right now, these businesses also would have struggled on the margins because of the input costs. But imagine the top line increasing because of the real estate upcycle, and some of these costs being passed on, by these companies to the end consumers, and the margins expanding, the profitability expanding, and with that, the re-rating of the multiples also coming in, and definitely that would finally lead to a stock price, is expected to lead to a stock price rise. So this is the entire journey that we are anticipating, and capturing a good upside of the real estate upcycle, but with lower volatility and stronger companies is what we would like to capture this cycle with. It started on 16th. We are ending, the NFO is ending on 29th. And Tejas Gutka is a fund manager here. He's already managing our ELSs. He comes from Temuhara. He joined us, of course, 2-3 years back. And the benchmark is Nifty Housing Index, TRI. So I stop here. And for any questions that you may have, would be happy to take them.
Thanks, Shaily. I think it was a wonderful, walkthrough of the housing sector and this particular NFO. So I think we have some questions. I'll just take them right away. So there's one situation like I'm already owning a house. Does that give me an exposure to the housing sector? And should I be taking an exposure to the Housing Opportunity Fund? Now, I think you mentioned at the start, but you have this question.
So if you are, owning a house or buying a house, you're buying it for your own living. That is not translating into any numerical growth on your portfolio, in your wealth. It's a good thing to buy a house and own it or whatever, but this one is about playing the real estate upcycle and participating in the growth of that real estate via these allied industries. I would again like to reiterate, we spoke about the housing sector in the first part because the underlying is housing, but what we are wanting to construct a portfolio out of is the allied products, allied industries which cater to the housing. Those cables, switchgears, tiles, paints, appliances, and all those companies. You look around, you will find in your house the companies which make all these products. You will have electrical fittings, wires, cables, glass, paint, tiles, plywood, board, appliances, ACs, everything. That's where we want to construct a portfolio with some, of course, cement companies, some bit of housing finance companies, some bit of banks, and maybe if there are any real estate strong developers, yes. So you are buying a house, of course, for your own living. That price would have gone up from, let's say, 1 crore to 2 crore or 50 lakhs to 1 crore. But does that really help you in your portfolio? No, this will help you participate in the upcycle of the housing, and you're playing it through these allied products, industries. That's the thing. So you're participating in the upcycle, but with lower volatility, and you're giving a downside protection to that theme, because we are being true to the theme. We are not wanting to go behind the benchmark. Benchmark could be whatever it is.
Correct. So I think the emphasis is on the investing as the housing sector grows in India versus
Yes.
the real estate, which is by itself an asset class which is currently owning.
Yes. Because we are investing into paint companies, tile companies, glassware companies, sanitaryware companies, your fittings, electrical fittings, all these companies. Because they are capital light, because they don't have too much of leverage, because they capture the real estate upcycle very well. But at any point in time, their revenues don't come off like a blip, because they have replacement demand. Even if real estate, more houses are not being built, there's no demand, but you always have replacement demand for paint companies and everything. So that's the entire storyline, or our narrative rather. That's our narrative. That's our conviction.
Yeah. So there's another question. Some of the incentives on the housing sector ended last financial year. Further to keep the momentum going, will there be any more socks from the government, which can, help boost the sector further to keep up the momentum?
So demand driver coming in from government schemes, there is enough housing schemes. I think some 20,000 crore worth or 18,000 crore, I think, was launched. Indirectly, government has done lots to help NBFCs, given them liquidity facilities, and it has done something specific for construction workers, So a lot of schemes are there, and there is enough from that side. And that's the external, the government side. You have enough happening on the macro and the micro side, which is your affordability index is improving, your urbanization is growing. These two things, your affordability index and improving, and your urbanization growing, is a good demand driver for housing sector. And then your suppliers are consolidating, and the demand supply equilibrium there was so much of inventory earlier, 35-40 months of inventory, which has now come to 20 months. And your absorption is your new launches have gone down, your prices have slightly improved, your absorption of that supply which was there has increased, and that is why your demand supply, your inventory is fine, and because your inventory is fine right now, your pricing is good. There is a pricing power which the developers are having. So you have a healthy developer side, supplier side, you have a healthy demand side, and you have external support from the government. All these things coming together are helping the housing sector.
Correct. So, so while
Also, one more point, sorry, one more point, Harsh.
yeah, go ahead.
The cement companies, the capacity utilization has reached a particular level, and all those companies by now have deleveraged, and their capacities utilization has gone up to a particular level. So both the things happening, and the rates are lower, interest rates. So all these three things are encouraging the companies to go and set up more capacities. So cement companies, you will see the sector has just expanded because people are putting, those companies are putting new capacities right now, because the utilization has reached and those companies have already deleveraged, so they have room, they have enough room to go and
Expand the
put up more
capacity.
capacity. Yes,
Yes.
yes, yes.
Yeah. So we have one more question. So while I think we saw a lot of key indicators stating the sector is expected to do good in the near and long term. But here while we are seeing a global slowdown and some of the news across the global market, will that impact the Indian housing sector by any chance?
So, global housing sector impacting, I think in India, the activity is very, very strong. Yes, globally, growth concerns are there, but they're also because of the commodity cool off, and other steps being taken. Inflation, of course, is a larger risk in developed economies than in India. In India, our inflation, and we also, and we raised this repo rate right now not to manage inflation. We did that because we wanted to have a decent gap between US Fed rate and us, so that our currency does not get hit. That was the idea. So in India, if we talk about domestic thing, inflation is expected to go to about 4 to 5% in FY 23-24. Our growth is resilient. Our quarterly earnings have been good. Banks are in a sweet spot. You see good order, inflows coming in for many of these. Our capacity, expansion, capex. Government has already been doing capex for the last 2-3 years. This budget announced a good increase of 35% in capital expenditure. Private sector capacity expansion has now started, and your capital good companies, your industrial product manufacturing companies, which is your ball bearings, abrasives, transformers, and your compressors, and all these companies are doing well, and they are growing. Their profitability is decent. So private sector capacity capex happening, government capex holding up, real estate upcycle, which is the household capex happening. We are good there. Banks are in a sweet spot. IT and pharma are reasonably, of course, evaluations have come up, and medium to long term growth, their demand drivers are definitely in place. So we in India, are in a decent space. Your PMI, manufacturing and services, is decent, is good. Yeah, our macro is good. Our current account deficit, in spite of the rise in inflation abroad, our import, because we also have import inflation, it was contained very well within 2.5%. And now, of course, all the commodity prices are coming off, and that cooling is also helping our import bills. And our fiscal deficit, even if there is some slippage, it is not expected to go and have higher borrowing. So, and currency is, we are the fourth largest currency reserve country, having that, and we were able to do some bit of intervention in the currency market recently because of the FII outflows happening. So all these put together, we are in a reasonable situation, with valuations correcting now. You've seen corrections in Feb, March. I think July was an upside month, but June was a good correction month. So our valuations have corrected now from 22x for 1 year forward P to some 17, 18x 1 year forward P. And this gives us a good entry point to this theme, which is expected to do well, is how I will place it.
Correct. So, as you mentioned, this fund is going to be slightly more cyclical. So what is the time horizon that an investor should, look forward to?
No, this fund would be less cyclical. Real estate itself is very, very cyclical, and that is why real estate developer companies, if you invest into, they are much more cyclical. This is a much more defensive play. It is not cyclical, because on the upside, these allied products do very well because of the boom in the housing sector. The upside will be this portfolio will be able to capture. But if real estate were to go, because it's cyclical, though it's not expected, we are expecting the housing sector upcycle to continue for the next 4 to 5 years. But even if there was something, this allied industry set still has the probability and the capacity to perform because of all those reasons that I mentioned. It is the quality of businesses is very strong. It does not need too much of capital. All it needs is working capital, and the debt is low, and it has replacement demand to support. So it can still continue to grow, the revenues. The top line would not grow 30%, 25%, but it can still continue to grow at 15, 16%. So that's the point which I was making. This portfolio won't be cyclical.
Yeah. If someone has to look forward for a particular investment or a time horizon, so what is the usual time horizon that you would recommend?
I think next 3 to 5 years, 4 to 5 years is what is something which you should look at. We are building the portfolio now. We'll build as soon as we close and launch. So from here on, you should give 4 to 5 years. One should give 4 to 5 years minimum to this theme to play out, and for us to provide the returns basis this theme.
And should one look at putting one shot lump sums to this fund during NFO, or the SIP would be a more better option to go forward?
We are constructing the portfolio right now, and we, as a house, we are a growth at reasonable price philosophy. We are not growth at any price. So definitely valuations are very, very important to us at any point in time. So if valuations are important to us, and we are taking that call at our end, and we expect, and we are saying that right now is a good time for this, from here on, it's a good time for this theme to perform. Lump sum, there is no harm in looking at a lump sum investment into this theme, because we are positioning, we are conveying, or we are carrying that conviction that this theme, the time for this theme is good now, and we will be playing it through the allied products. And we are very valuation sensitive, growth at reasonable price. So we will construct the portfolio afresh accordingly now.
Correct. So I think, Shaily, we've come to the end of our session today. I think it was extremely insightful, to gain all the insights about the housing sector. Thank you for your time and patience to conduct this. And I personally hope this video is seen by more and more millennials, to help them understand the housing sector more efficiently. So anyone who is wanting to invest, into Tata Housing Opportunity Fund, please log into the Moneyfy app. The link to download the app is given in the description below. You can open your account within minutes and invest in this NFO. Thanks, Shaily, for your time.
Thank you. Our pleasure, totally. Thank you, everyone. Thanks all the viewers, and thanks Harsh and Tata Capital Moneyfy.